The average American pays about 14% of their income in federal taxes. Some of the richest people on Earth have paid as little as 3%. This 3% rate is achieved through a completely legal strategy that has been sitting in the tax code for decades. The U.S. system taxes income, not wealth. If your money comes from a paycheck, the IRS taxes it immediately because it's moving. But if your wealth sits in the form of property or stock, it isn't taxed at all. This creates unrealized gains. When a billionaire's portfolio grows, it remains tax-free unless sold. The government takes a slice from the paycheck on the left, while the right stock chart keeps growing. Of U.S. billionaires' $4.25 trillion in wealth, $2.7 trillion is unrealized, meaning it's never been taxed. Because this wealth isn't counted as income, their reported earnings can look tiny on paper. In 2020, at least 18 billionaires reported taxable incomes low enough to qualify for a government stimulus check. But if you never sell your assets to avoid the tax, how do you actually get the cash to fund your lifestyle? Step 1 is buy. The strategy begins by acquiring appreciating assets like stocks, real estate, and private businesses, with the intent of never selling them. Warren Buffett is a primary example of this approach, avoiding taxable events by holding his Berkshire Hathaway shares for decades. Between 2015 and 2018, Buffett reported an annual taxable income of between $11.6 and $25 million, a tiny fraction of how much his actual net worth grew in that same window. Wealthy owners further suppress their taxable income using deductions like real estate depreciation. This allows them to claim on paper that a property is losing value, even while its market price continues to climb. They can also structure expensive personal assets as hobby businesses. ProPublica found 6 owners of thoroughbred racehorses at a single Kentucky Derby claiming a combined $600 million in tax write-offs for their operations. This first step allows wealth to grow in a tax-free bubble, but it still leaves the billionaire without liquid cash for daily spending. That leads to step 2, borrow. Instead of selling stock to get cash, they use their unsold portfolio as collateral to secure massive bank loans. Because a loan must be paid back, the IRS does not classify it as income. The cash from that loan is 100% tax-free, despite being spent exactly like a salary. Elon Musk utilized this strategy at a massive scale to fund his business moves. To access billions in liquid cash without selling shares, he borrowed $6.25 billion against his Tesla stock to help fund his purchase of Twitter. By living on borrowed cash rather than a paycheck, the ultra-wealthy detach their spending from the income tax system entirely. Eventually, the loans must be repaid and the capital gains settled. This is where the final step comes in. Die. When the billionaire dies, heirs inherit assets through a step up in basis. This resets the asset's value to current market price, wiping out decades of accumulated capital gains tax liability. The family can sell the assets tax-free or restart the borrowing cycle. The government's ability to collect on those decades of growth legally expires the moment the owner passes away. Average homeowners already use a retail version of this strategy when they take out a HELOC to borrow tax-free cash against their home's equity. Regular investors can also apply the buy and hold logic by using tax-advantaged accounts like 401ks and Roth IRAs to minimize taxable events. However, the full strategy remains out of reach for the average worker because banks will only offer low-interest lifestyle loans to those with massive multi-million-dollar portfolios as collateral. This is published tax law. The system is built to tax paycheck labor differently than it taxes asset ownership. If this is the first time you've heard buy, borrow, die explained clearly, hit subscribe. Next week, we're breaking down the exact moves regular investors can use to legally pay less tax.